We discuss pension benefits and other post-retirement benefits in this chapter. Accounting for pension benefits recognizes that they represent deferred compensation for current service. Accordingly, the cost of these benefits is recognized on an accrual basis during the years that employees earn the benefits. Pension plans are designed to provide income to individuals during their retirement years. This is accomplished by setting aside funds during an employee's working years so that at retirement the accumulated funds plus the earnings from investing those funds are available to replace wages. Financial reporting responsibility for pension is important social and economic implications. Corporations establish pension plans for a wide variety of reasons. Sponsorship of pension plans provides employees with a degree of retirement security and fulfills a moral obligation felt by many employers. This security also can induce a degree of job satisfaction and perhaps loyalty that might enhance productivity and reduce turnover. Motivation to sponsor a plan sometimes comes from union demands and often relates to being competitive in the labor market. Sometimes employers agree to annually contribute a specific, defined amount of pension fund on behalf of employees, but make no commitment regarding benefit amounts at retirement. In other arrangements, employers don't specify the amount of annual contributions, but promise to provide determinable or defined amounts at retirement. These two arrangements describe defined contribution pension plans and defined benefit pension plans, respectively. Defined contribution pension plans promise fixed annual contributions to a pension fund, say 5% of an employer's salary. Employees choose from designated options where the funds are invested, usually stocks or fixed income securities. Retirement pay depends on the size of the fund at retirement. Defined benefit pension plans promise fixed retirement benefits defined by a designated formula. Typically, the pension formula bases retirement pay on the employee's A, years of service, B, annual compensation, often the final pay or average pay for the last few years, and sometimes C, age. Employers are responsible for ensuring that sufficient funds are available to provide for the promised benefits. Both types of plan have a common goal to provide income to employees during their retirement year. Still, the two types of plans differ regarding who bears the risk, the employer or the employees, or whether the current objectives are achieved. The two types of plans also have an entirely different implication for accounting and financial reporting. Our discussion of defined contribution plans will be brief. Although these are now the most popular type of corporate pension plan, their relative simplicity permits a rather straightforward accounting treatment that requires little explanation. On the other hand, defined benefit plans require considerably more complex accounting treatment and constitute the primary focus of this chapter. Defined contribution plans promise fixed periodic contributions to a pension fund. Retirement income depends upon the size of the fund at retirement. No further commitment is made by the employer regarding the benefit amounts at retirement. These plans have several variations. In money purchase plans, employers contribute a fixed percentage of employees' salaries. Thrift plans, savings plans, and 401k plans, named after the tax code section that specifies the conditions for favorable tax treatment, permit voluntary contributions by employees. These contributions typically are matched by a specified extent by employers. Most employers match up to 50% of the employee contributions up to the first 6% of salary. When plans link the amount of contributions to company performance, labels include profit-sharing plans, incentive savings plans, 401k profit-sharing plans, and similar titles. When employees make contributions to the plan in addition to employer contributions, it's called a contributory plan. Sometimes the amount the employer contributes is tied to the amount of the employee contribution. An example from a recent annual report of Microsoft Corporation is shown in the above illustration. Each year, the employer simply records pension expense equal to the amount of the annual contribution. Suppose a plan promises an annual contribution equal to 3% of an employee's salary that amounts to $110,000 in a particular year. The employer would simply recognize pension expense in the amount of the contribution. We see that a pension is an expense that we debit pension expense account with $3,300 calculated as the annual salary times 3%, or $110,000 times 3% amounting to $3,300. We credit cash account with the same amount as the pension is paid. Unlike defined contribution pension plans, defined benefit pension plans promise fixed retirement benefits defined by a designated formula. A typical formula might specify that a retiree will receive annual retirement benefits based upon the employee's years of service and annual pay at retirement, say pay level in the final year, highest pay achieved, or average pay in the last 2 or more years. For example, a pension formula might define annual retirement benefits as 1.5% times the years of service times final year's salary. By this formula, the annual benefits to an employee who retires after 30 years of service with a final salary of $100,000 would be 1.5% times 30 years times $100,000 is $45,000. When setting aside cash to fund a pension, the uncertainty surrounding the rate of return on plan assets is but one of the several uncertainties inherent in a defined benefit plan. Employee turnover affects the number of employees who ultimately will become eligible for retirement benefits. The age at which employees will choose to retire, as well as life expectancies, will impact both the length of the retirement period and the amount of the benefits. Inflation, future compensation levels, and interest rates also have obvious influence on eventual benefits. Typically, a firm will hire an actuary, a professional trained in a particular branch of statistics and mathematics, to assess the various uncertainties, employee turnover, salary levels, mortality, etc., and to estimate the company's obligation to employees in connection with its pension plan. Such estimates are inherently subjective, so regardless of the skill of the actuary, estimates invariably deviate from the actual outcome from one degree or another. The return on assets can turn out to be more or less than expected. These deviations are referred to as gains or losses on pension assets. When it's necessary to revise estimates related to the pension obligation because it's determined to be more or less than previously thought, these revisions are referred to as losses and gains respectively on the pension liability. Later we will discuss the accounting treatment of gains and losses from either source. The point here is that the risk of pension obligation changing unexpectedly or the pension funds being inadequate to meet the obligation is borne by the employer with a defined benefit pension plan. The key elements of a defined benefit pension plan are the employee's obligation to pay retirement benefits in the future, the plan assets set aside by the employer from which to pay the retirement benefits in the future, and the periodic expense for having a pension plan. We will learn in this chapter that the first two elements are not reported individually for the employer's financial statements. It is important to understand the composition of both the pension obligation and the plan assets because they are reported as a net amount in the balance sheet, and their balances are reported in the disclosure notes. And more importantly, the pension expense reported in the income statement is a direct composite of periodic changes that occur in both the pension obligation and the plan assets. Today, an approximate of 3/4 of workers are covered by defined contribution plans. The remaining workers are covered by defined benefit plans. This represents a radical shift from previous years when the traditional defined benefit plan was far more common. In fact, many new companies are terminating long-standing defined benefit plans and substituting defined contribution plans. This shift is due to three main reasons. Government regulations make defined benefit plans cumbersome and costly to administer. Employers are increasingly unwilling to bear the risk of defined benefit plans. With defined contribution plans, the company's obligation ends when the contributions are made. There has been a shift among many employers from trying to buy long-term loyalty with defined benefit plans to trying to attract new talent with more mobile defined contribution plans. The annual pension expense reflects changes in both the pension obligation and the plan assets. The above illustration provides a brief overview of how these changes are included in pension expense. Note that the actual return is adjusted for any difference between actual and expected return, resulting in the expected return being reflected in pension expense. This loss or gain from investing plan assets is combined with losses and gains from revisions in the pension liability for deferred inclusion in pension expense. Interest and investment returns are financing aspects of the pension cost. The recognition of some elements of the pension expense is delayed. Now we consider more precisely what is meant by the pension obligation. Unfortunately, there's not just one definition, nor is there uniformity concerning which definition is the most appropriate for pension accounting. Actually, three different ways to measure the pension obligation have meaning in a pension accounting, as shown in the above example. 1. Accumulated benefit obligation referred to as ABO, the actuary's estimate of the total retirement benefits at their discounted present value earned so far by employees, applying the pension formula using existing compensation levels. 2 is the vested benefit obligation, or the VBO, the portion of the accumulated benefit obligation that the plan participants are entitled to receive regardless of their continued employment. And 3, projected benefit obligation, referred to as the PBO, the actuary's estimate of the total retirement benefits at their discounted present value earned so far by employees. Applying this pension formula using the estimated future compensation levels. If the pension formula does not include future compensation levels, the PBO and ABO are the same. The accumulated benefit obligation is an estimate of the discounted present value of the retirement benefits earned so far by employees, applying the plan's pension formula using existing compensation levels. When we look at a detailed calculation of the projected benefit obligation later, keep in mind that it's simply substituting the employee's existing compensation in the pension formula for her projected salary at retirement would give us the accumulated benefit obligation. Suppose an employee leaves the company to take another job. Will she get to keep her earned benefits at retirement? The answer depends on whether the benefits are vested under the terms of this particular pension plan. If benefits are fully vested, then yes. Vested benefits are those that employees have the right to receive even if their employment were to cease today. Vested benefit obligation is the portion of the accumulated benefit obligation that plan participants are entitled to receive regardless of their continued employment. Today, benefits must vest A, fully within 5 years, or B, 20% within 3 years, another 20% vesting each subsequent year until fully vested after 7 years. 5-year vesting is the most common. Before the Employee Retirement Income Security Act, known as ERISA, passed in 1974, vesting requirements were tightened drastically to protect employees. These requirements have been changed periodically since then. ERISA also established the Pension Benefit Guaranty Corporation to impose liens on corporate assets for unfunded pension liabilities in certain instances and to administer terminated pension plans. The PBGC, also known as Penny Benny, provides a form of insurance to employees similar to the role of the FDIC for banks, and financed by premiums for employers equal to specified amounts for each covered employee. It makes retirement payments for terminated plans and guaranteed basic vested benefits when pension liabilities exceed assets. Since it is unlikely that there will be no salary increases between now and retirement, a more meaningful measure should be projected of what the salary might be at retirement. Measured this way, the liability is referred to as the projected benefit obligation. The PBO estimates retirement benefits by applying the pension formula using projected future compensation levels. Hereafter in the chapter we mention the pension obligation, we are referring to the PBO. The PBO measurement may be less reliable than the ABO, but it is more relevant and representationally faithful. The relationship among three obligations is as depicted in the above illustration. To understand the concept better, we will simplify our illustration by looking at how pension amounts would be determined for a single employee. Here in this illustration, Jessica Farrow was hired by Global Communication in 2005. The company has a defined benefit pension plan. Thus, the annual retirement benefits is calculated by the pension formula. Farrow is expected to retire in 2044 after 40 years of service. Her retirement period is expected to be 20 years. Her salary is $100,000 at the end of 2014, and the interest rate is 6%. The actuary projects that if Farrow's salary to be $400,000 at the time of retirement, we are asked to find the company's projected benefit obligation. The steps to calculate the projected benefit obligation are: use the pension formula, including a projection of future salary levels to determine the retirement benefits earned to date. Find the present value of the retirement benefits as of the retirement date, and find the present value of retirement benefits as of the current date. Concept check. Step 1. Using the pension formula where the projected future salary is $400,000 and years of service is 10, we determine the retirement benefits earned to date to be $60,000 per year. Step 2. We find the present value of the retirement benefits as of the retirement date to be $688,195. Step 3. The present value of the retirement benefits as calculated by the current date by discounting the retirement annuity of $688,195 for 30 years is $119,822. Concept check. Now, for the same illustration, if the actuary's estimate of the final salary hasn't changed, the PBO a year later at the end of 2015 would be $139,715 as demonstrated in the above illustration. The change in PBO amount is due for two reasons. One more service year is included in the pension formula calculation, the service cost. And two, the employee is 1 year closer to retirement, causing the present value of benefits to increase due to the time value of future benefits, the interest cost. Note, in the pension formula, the service years is now 11 years instead of 10. Consequently, 2015 is 1 year closer to the retirement date. That is, N equals 29. For the purpose of calculating the present value, the PBO has increased from 119,822 to 139,715. The five events that might possibly cause the balance of the PBO to change are 1. Service cost, 2. Interest cost, 3. Prior service cost, 4. Gains and losses, and 5. Payments to retired employees. As we just witnessed in the illustration, the PBO increases each year by the amount that the year's service cost. This represents the increase in projected obligation attributable to the employee's service performed during the period. Also, it is the primary component of the annual pension expense. Interest cost. Even though the projected benefit obligation is not formally recognized as a liability in the company's balance sheet, it is a liability nevertheless. And as with other liabilities, interest accrues on its balance as time passes. The amount can be calculated directly as the assumed discount rate multiplied by the projected benefit obligation at the beginning of the year. Prior service cost. Another reason the PBO might change is when the pension itself is amended to revise the way benefits are determined. For example, assume that Global Communications in our illustration revised the pension formula. Formula salary percentage is increased in 2015 from 1.5% to 1.7%. Obviously, the annual service cost from this date forward will be higher than it would have been without the amendment, but it also might cause an immediate increase in the PBO as well. This is because most companies choose to make amendments retroactive to prior years. In other words, the more beneficial terms of the revised pension formula are not applied just to future service years, but benefits attributable to all prior service years also are recomputed under the more favorable terms. Making the amendment retroactive to prior years adds an extra layer of retirement benefits, increasing the company's benefit obligation. For instance, the above note represents an excerpt from an annual report of Ecolab, Inc., describing the increase in PBO as a result of making an amendment retroactive. Next, let's put prior service cost in context of our prior illustration. At the end of 2014, and therefore the beginning of 2015, the PBO is $119,822. If the plan is amended on January 3, 2015, the PBO for that date could be recomputed as shown. Note, the amended salary percentage is now 1.7%. Prior service costs increased the PBO at the beginning of the year. The $15,976 increase in the PBO attributed to applying the more generous terms of the amendment to prior service years is a prior service cost. And because we assume the amendment occurred at the beginning of 2015, both the 2015 service cost and the 2015 interest cost would change as a result of the prior service cost. The plan amendment would affect not only the year in which it occurs, but also the subsequent year because the revised pension formula determines each year's service cost. Note that in the above illustration, during 2016, the PBO was increased as a result of service cost and interest cost. Gains and losses. We mentioned earlier that a number of estimates are necessary to derive the pension benefit obligation. When one or more of these estimates requires revision, the estimate of the PBO will also require revision. The resulting decrease or increase in PBO is referred to as a gain or loss, respectively. Let us modify our illustration to imitate the effect of revising one of the several possible estimates involved. Suppose at the end of 2016, inflation and compensation trends suggest that the estimate of Pharaoh's final salary should be increased by 5% to $420,000. The difference of $9,155 represents a loss on the PBO because the obligation turned out to be higher than previously expected. Now there would be three elements to increasing the PBO in 2016. If a revised estimate caused the PBO to be lower than previously expected, a gain would be indicated. Consider how a few other possible estimate changes would affect the PBO. A change in life expectancies might cause the retirement period to be estimated as 21 years rather than 20. Calculation of the present value of the retirement annuity would use 21 rather than 20. The estimate of the PBO would increase. The expectation that retirement would occur 2 years earlier than previous thought and would cause the retirement period to be estimated as 22 years rather than 20 years, and the service period to be estimated as 28 years rather than 30 years. The new expectation would probably also cause the final salary estimate to change. The net effect on the PBO would depend on the circumstances. A change in the assumed discount rate would affect the present value calculations. A lower rate would increase the estimate of the PBO. A higher rate would decrease the estimate of the PBO. Payment of retirement benefits. Another change in the PBO occurs when the obligation is reduced, as benefits actually are paid to retired employees. The above illustration summarizes the 5 ways that the PBO can change. For our single employee, the PBO at the end of 2016 is $192,254. Let's say now that Global Communications has 2,000 active employees covered by the pension plan and 100 retired employees receiving retirement benefits. The above illustration expands the numbers to report all covered employees. Concept check. So far, our focus has been on the employer's obligation to provide retirement benefits in the future. We turn our attention now to the resources with which the company will satisfy the obligation, the pension plan assets. Like the PBO, the pension plan assets are not reported separately in the employer's balance sheet, but are netted together with the PBO to report either a pension asset, a debit balance, or a pension liability, a credit balance. Its separate balance, too, must be reported in the disclosure notes on the financial statements, as does the separate PBO balance. The return on these assets is included in the calculation of the periodic pension expense. The assets of a pension fund must be held by a trustee. A trustee accepts employer contributions, invests the contributions, accumulates the earnings of the investment, and pays benefits from the plan to retired employees or their beneficiaries. The trustee can be an individual, a bank, or a trust company. Plan assets are invested in stocks, bonds, and other income-producing assets. The accumulated balance of the annual employer contributions plus the return on investments, dividends, interest, market price appreciation, must be sufficient to pay benefits as they come due. Concept check. Concept check. In this illustration, we will determine the value of pension plan assets at the end of the year and see if it is sufficient for Global's PBO. Plan assets at the beginning of 2016 were valued at $300 million. The expected rate of return on the investment of those assets was 9%, but the actual return in 2016 was 10%. Retirement benefits of $38 million were paid at the end of 2016 to retired employees. It is also said that Global's PBO at the end of 2016 is $450 million. Based on this information, we calculate the plan assets at the end of 2016 to be $340 million because the plan assets are only $340 million while the required amount was $450 million. The pension plan is said to be underfunded. When an employee estimates how much it must set aside each year to accumulate sufficient funds to pay retirement benefits as it comes due, it's necessary to estimate the return on those investments will produce. This is the expected return on plan assets. The higher the return, the less the employer must actually contribute. On the other hand, a relatively low return means the difference must be made up by higher contributions. In practice, recent estimates of the rate of return have ranged from 4.8 to 9%, with 7.75% being the most commonly reported expectation. A company's pension benefit obligation is not reported separately among liabilities in the balance sheet. Similarly, the plan assets of a company sets aside to pay those benefits are not separately reported among assets in the balance sheet. However, firms do report the net difference between the two amounts, referred to as the funded status of the plan. From our previous discussion, we see that the funded status for Global is to be the following: December 31st, 2016 and December 31st, 2015. Because the plan is underfunded, Global reports a net pension liability of $110 million in its 2016 balance sheet and $100 million in 2015. It is important to note that the real net pension liability is not an actual account balance. Instead, it is the PBO account balance and the plan asset account balance, simply reported in the balance sheet as a single net amount. If the plan becomes overfunded in the future, Global will report a net pension asset instead. Note, the company must report in its balance sheet a liability for the underfunded or asset for the overfunded status of its post-retirement plans. Concept check. Concept check. Like wages, salaries, commissions, and other forms of pay, pension expense is part of a company's compensation for employee services each year. Accordingly, the accounting objective is to achieve a matching of these costs of providing the form of compensation with the benefits of the service performed. However, the fact is this form compensation actually is paid to employees many years after the service is performed, means that other elements in addition to the annual service cost will affect the ultimate pension cost. These other elements, as related to changes that occur over time in both the pension obligation and pension plan assets. The above illustration provides a summary of how some of these changes influence pension expense. The above illustration demonstrates the relationship between some of the changes in the PBO and the plan assets and the components of pension expense, service cost, interest cost, the return on plan assets, prior service cost, amortization, and net gain or loss amortization. We will look at these components of pension expense over a time in the next few slides. The 41 million service cost represents an increase in projected benefit obligation attributable to employee services performed during 2016. Benefits earned by the employees during the year. Each year, this is the first component of the pension expense. Next, the interest cost is calculated as the interest rate multiplied by the projected benefit obligation at the beginning of the year. Thus, in 2016, it is calculated as 6% times 400 million, or 24 million. We discussed earlier, we'll revisit later, the PBO is combined with pension assets with the net difference reported in the balance sheet as either a net pension liability or net pension asset. Thus, the interest expense that accrues on the balance sheet is not separately reported on the income statement, but instead becomes the second component of annual pension expense. Remember, plan assets comprise funds invested in stocks, bonds, and other securities. These assets will presumably generate dividends, interest, and capital gains. The return earned on investment securities increases the plan's asset balance, When accounting for the return, we need to differentiate between its two modes and the expected future return on the actual return. Actual versus expected return. We've assumed Global's rate of return is 9%, so it is expected to return on plan assets in 2016 was 9% times 300 million or $27 million. But as previously indicated, the actual rate of return in 2016 was 10%, producing an actual return on plan assets of 10% times 300 million or 30 million. The return on plan assets reduces the net cost of having the pension plan. Accordingly, the return on plan assets each year reduces the amount recorded as pension expense. Actually, both the interest and return on assets components of pension expense do not directly represent employee compensation. Instead, they are financial items created only because the future obligation to retirees must be funded currently. Adjustment for loss or gain. Since the net cost of having a pension plan is reduced by the actual return on plan assets, the charge to pension expense should be the actual return on plan assets. However, the Financial Accounting Standards Board has concluded that the actual return should first be adjusted by any difference between that return and the return amount that had been expected. Therefore, it is actually the expected return that is included in the calculation of pension expense. Thus, in our illustration, Global's pension expense is reduced by the expected return of 27 million. The difference between the actual and expected return is considered a loss or gain on plan assets. Although we don't include these losses or gains as part of the pension expense when they occur, it is possible they will affect pension expense at a later time. Note that the illustration, the plan amendment, occurred in 2015, which increased the PBO at the time. Also recall that the individual employee, Jessica Farrow, the prior service cost was calculated to be $15,976. We also assumed that for all plan participants, the prior service cost was $60 million at the beginning of 2015. The prior service cost at the beginning of 2015 is $55 million. But how did we get this amount? We will learn the same now. For this, we assume that the average remaining service life of the active employee group is 15 years. To amortize the prior service cost of $60 million in equal annual amounts, we use the straight method. By the straight line method, prior service cost is recognized over the average remaining service life of the active employee group. Thus, by dividing the prior service cost of $60 million over the average remaining life of service, the active employee group, 15 years, we determined that the amount experienced will increase in pension plan expense each year is $4 million. It is important to note that even though we're amortizing it, the prior service cost is not an asset. Rather, it is reported as a component of accumulated other comprehensive income, a shareholder's equity account to be amortized over time. This treatment is because of FASB's disinclination to treat the cost as an expense as it is incurred. The board instead prefers to consider it to be an other comprehensive income, like the handful of losses and gains is categorized in the same way and not reported among the gains and losses in the traditional income statement. We'll revisit this again later this chapter. The prior service cost balance in accumulated other comprehensive income declines by the amount calculated by the straight line method each year. Thus, we calculate the prior service cost balance at the end of the year as 52. The prior service We know that gains and losses can occur when expectations are revised concerning whether the PBO or the return on plan assets. Like the prior service costs we just discussed, we don't include these gains and losses as part of pension expense in the income statement, but rather report them as OCI in the statement of comprehensive income as they occur. When we report the gains and losses, net of subsequent amortization, on a cumulative basis as the net loss AOCI, accumulated other comprehensive income, or net gain, accumulated other comprehensive income, depending on whether we have a greater loss or gains over time. We report this amount in the balance sheet as part of accumulated other comprehensive income, AOCI, a shareholder's equity account. There is no conceptual justification for not including the losses and gains in earnings. After all, these increases and decreases in either the PBO or plan assets immediately impact the net cost of providing a pension plan and conceptually should be included in pension expense as they occur. The above illustration summarizes the possibilities of gains and losses that occur when expectations are revised concerning whether the PBO or the return on plan assets. The FASB acknowledged the conceptual shortcoming in delaying the recognition of gain or loss while opting for this more politically acceptable approach called income smoothing. The board acknowledges that the delayed recognition included in this statement results in excluding the most current and most relevant information. The practical justification for delaying recognition is that over time, gains and losses might cancel one another out. Given this possibility, why create unnecessary fluctuations in reported income by letting temporary gains and losses decrease and increase pension expense respectively? But as years pass by, there may be more gains and losses or vice versa. That hampers their offsetting completely. So if a net gain or a net loss gets too large, pension expense must be adjusted. Therefore, according to FASB, a net gain or net loss affects the pension expense only if it exceeds the amount equal to 10% of the PBO or 10% of the plan assets, whichever is higher. This threshold amount of 10% is called the corridor. Again, when the net gains or net losses exceeds the corridor, the excess is not charged to pension expense all at once. Instead, a further concession to income smoothing, only a portion of the excess is included in pension expense. The minimum amount that should be included is the excess divided by the average remaining service period of active employees expected to receive benefits under the plan. In our illustration, we're assuming a net loss of AOCI of $55 million in the beginning of 2016. Also recall that the PBO and plan assets are $400 million and $300 million respectively at that time. Based on this information, we're going to calculate the amount that should be amortized to the 2016 pension expense. The corridor is 10% of PBO, that's $40 million. We have taken PBO as the base for the calculation because in this case, PBO is higher than plan assets. Thus, we find that the net loss of $15 million in excess at the beginning of the year. Previously, we assumed that the average remaining service life of an employee is estimated to be 15 years. Dividing the excess loss of $15 million by the average remaining service period of 15 years, we determined that the amount amortized in 2016 pension expense to be $1 million. The pension expense is increased because a net loss is being amortized. If a net gain were being amortized, the amount would be deducted from the pension expense because a gain would indicate that the balance in net cost of providing the pension plan had decreased. New losses add to net loss. New gains reduce a net loss. Consequently, amortization of $1 million reduces the net loss, AOCI in 2016, by $1 million. Also recall that Global incurred a $23 million loss in 2016 from revising estimates relating to the PBO and a $3 million gain when the 2016 return on plan assets was higher than expected. These three changes affected the AOCI in 2016 to result in a balance of $74 million. As we discussed earlier, gains and losses are deferred and not immediately included in pension expense and net income. Instead, we report them as other comprehensive income in the statement of comprehensive income. It is given that Global records a loss, OCI, for the $23 million loss that occurs in 2017, when it revises its estimate of future salary levels, causing its PBO to increase. Global also records a $3 million gain to OCI that occurred when the $30 million actual return on plan assets exceeded the $27 million expected return. To record the loss relating to the PBO, we debit loss, OCI, with $23 million and credit PBO with the same amount. The loss is an increase in the PBO due to the change in assumptions. In this entry, we are recording that the increase in PBO account balance. If the change in assumptions had caused the PBO to be reduced instead, we would debit the PBO here and credit a gain, OCI. Similarly, a gain due to the actual return on plan assets exceeding the expected return is an increase in plan assets. To record this gain relating to plan assets, we debit plan assets with $3 million and calculate it in the difference between the actual and expected return. Credit gain, OCI, with the same amount. Each component of the pension expense is recorded in the journal entry to record pension expense. Service cost and interest cost increase the PBO. The return on plan assets increases plan assets. Now let's see how the pension expense is recorded. Recall that Global's 2016 pension expense is $43 million. The pension expense includes $41 million of service cost and the $24 million of interest cost. Both add to Global's PBO. Similarly, the pension expense includes a $27 million expected return on plan assets, which adds to the plan assets. The pension expense also includes $4 million amortization of the prior service cost and $1 million amortization of the net loss. As we discussed earlier, we report prior service cost when it arises, as well as gains and losses as they occur, as other comprehensive income, OCI, in the statement of comprehensive income. These OCI items accumulate as prior service cost, AOCI, and net loss or gain, AOCI. So, when we amortize these AOCI accounts, we report the amortization accounts as OCI items in the statement of comprehensive income. These amortized amounts are being reclassified from OCI to net income. Amortization reduces the prior service cost, AOCI, and the net loss, AOCI. Since these accounts have debit balances, we credit the accounts for the amortization. If we were amortizing the net gain, we would debit the account because the net gain has a credit balance. Remember, we report the funded status of the plan in the balance sheet. That's the difference between the PBO and the plan assets. In this case, it's a net pension liability since the plan is underfunded. That is, the PBO exceeds the plan assets. The pension expense is, of course, reported in the income statement. In addition to the composition of that amount must be reported in disclosure notes. For instance, General Mills Incorporated described the composition of its pension expense in the disclosure note in its 2013 annual report shown in the illustration above. Let's now journalize the funding of plan assets and the payment of retirement benefits. When Global adds its annual cash investment to its plan assets, the value of those plan assets increases by $48 million. Thus, we debit plan assets with $48 million and credit cash account with the same amount. As cash has been invested in the plan assets, it's not unusual for the cash contribution to differ from that year's pension expense. Also determine that the periodic pension expense and funding of the, of the pension plan are two separate processes. The Pension Protection Act of 2006 and the Employee Retirement Income Security Act of 1974, ERISA, established the pension funding requirements. Subject to these considerations, cash contributions are actuarially determined with the objective of accumulating, along with investment returns, sufficient funds to provide promised retirement benefits. As we discussed earlier, when pension benefits are paid to retired employees, these payments reduce the plan assets established to pay the benefits and also reduce the obligation to pay the benefit. We know that PBO is a liability and has a credit balance. Thus, to reduce it, we debit PBO with $38 million, and we know that plan assets has a debit balance. Therefore, to reduce it, we credit it with the same amount. Now that we've recorded the entries for the funding of the pension plan and payment of benefits, we will now see how to record all the changes in the PBO and plan assets. Here, for PBO, the opening balance, loss on PBO, service cost, interest cost, and the opening balance are the amounts that we calculated in our previous illustrations. Similarly, the amounts considered in plan assets are also taken from the previous illustrations. Remember, we don't report either of these balances separately in the balance sheet. Instead, we combine the two and report a net pension liability of $450 minus $340 of $110 million, the funded status of the pension plan. Recall from Chapter 4 that comprehensive income is a more expansive view of income than traditional net income. In fact, it encompasses all changes in equity other than from transactions with owners. So in addition to net income, comprehensive income includes up to 4 other changes in equity. A statement of comprehensive income is demonstrated in the illustration, highlighting the presentation of the components of OCI pertaining to Global's pension plan. Gains and losses, as well as any new prior service cost, should it arise, are among the OCI items reported in the period they occur. As mentioned earlier, here in the statement of comprehensive income, we can see the 4 other changes in equity. That is, loss, due to revising a PBO estimate; gain, return on plan assets exceeds expectations; amortization of net loss; and amortization of prior service cost. These amounts are shown without considering taxes. Actually, each of the elements of comprehensive income should be reported net of tax. For instance, if the tax rate is 40%, the loss would be reported as $13.4 million, calculated as $23 million less a $9.2 million tax benefit. Other comprehensive income items are reported both as they occur and then as they accumulate balance in the shareholders' equity in the balance sheet. In addition to reporting the gains and losses that occur in the current reporting period, we also report the amounts on an accumulative basis in the balance sheet. Comprehensive income includes net income and OCI. Remember, when we report net income, that occurs in the current reporting period in the income statement. Also remember, we report accumulated net income in the balance sheet as retained earnings. Similarly, we report OCI as it occurs in the current reporting period as we did in the previous illustration, and also report AOCI in the balance sheet. This illustration shows how in 2016 balance sheet Global will report the amounts related to the pension expense. Since Global's pension plan is underfunded, there is a net pension liability of $110 million. If the plan had been overfunded, Global would have reported pension asset among its assets rather than pension liability. Note that the net loss prior to service costs reduced shareholders' equity. Also note that the net loss AOCI and prior service cost AOCI are debit balances and therefore negative components of accumulated other comprehensive income, while a net gain AOCI would have a credit balance and be a positive component of accumulated other comprehensive income. It is important to note that the pension liability represents the underfunded status of Global's pension plan on the two dates. We have ignored the income tax effect of the amounts in order to focus on the concepts. Note, though, that as gains and losses occur, they are reported along with their tax effects, tax expense for a gain and tax savings for a loss, in the statement of comprehensive income. This can be accomplished by presenting components of other comprehensive income, either net of related income tax effects or before income tax effects. It should be accompanied with a disclosure of the income taxes allocated to each component, either in a disclosure note or parenthetically in the statement. Similarly, if any new prior service cost should arise due to a plan amendment, it too would be reported of net of tax or with tax effects shown parenthetically. Likewise, AOCI in the balance sheet also is reported net of tax. In the preceding sections we've discussed, 1. The projected benefit obligation, including changes to periodic service costs, accrued interest, revised estimates, plan amendments, and the payment of benefits. And 2. The plan assets, including changes in investment returns, employer contributions, and payment of benefits. 3. Prior service costs. 4. Gains and losses. 5. The periodic pension expense comprising components of each of these, and 6. The funded status of the plan. These elements of a pension plan are interrelated. It is helpful to see how each element relates to the others. One way of bringing each part together in order to see how the element relates to each other is a pension spreadsheet. Thus, we will now prepare and understand a pension spreadsheet for our global communications illustration. Notice that the first numerical column simply repeats the actuary's report of how the PBO changed during the year, as explained previously. Likewise, the second column reproduces the changes in plan assets we discussed earlier. We've also previously noted the changes in prior service cost, AOCI, and the net loss, AOCI, that are duplicated in the third and fourth columns. The fifth column repeats the calculation of the 2016 pension expense that we determined earlier. The cash contribution column to the pension fund is the sole item in the next column. The last column shows the changes in funded status of the plan. Note that the funded status is the difference between the PBO, column 1, and the plan assets, column 2. Therefore, that means that each of the changes we see are either in the first two columns, reflected as a change in funded status in the last column. The net pension liability or pension asset balance is not carried in company records. Rather, we use this label to report PBO and plan assets in the balance sheet as a single amount. Companies sometimes terminate defined benefit plans to reduce costs and lessen risk. Instead, they provide defined contribution plans. When a plan is terminated, GAAP requires a gain or loss be reported at that time. For instance, let us look at the disclosure note shown in the illustration above of Melville Corporation that describes the termination of its pension plan. As we just discussed, most companies have pension plans that provide for the future payments of retirement benefits to compensate employees for their current services. Companies also furnish post-retirement benefits for other than pension to their retired employees. These may include medical coverage, dental coverage, life insurance, group legal services, and other benefits. The most common is healthcare benefits. It is important to distinguish retiree healthcare benefits from healthcare benefits provided during an employee's working years. A retiree plan is a deferred aspect of post-retirement benefits, whereas the annual cost of providing a health plan is the pre-retirement benefit. That is similarly a part of annual compensation expense. Generally, a plan assures benefits in exchange for services performed over a designated number of years or reaching a particular age or both. In other words, eligibility usually is based on age and/or years of service. Eligibility requirements and the nature of benefits usually are specified by a written plan or sometimes only by company practice. In fact, accounting for post-retirement benefits is similar to accounting for pension benefits. This is because the two forms of benefits are fundamentally similar. Each is a form of deferred compensation earned during the employee's service life, and the second one being each can be estimated as the present value of the cost of providing an expected future benefit. Prior to 1993, employers accounted for post-retirement benefits cost on a pay-as-you-go basis, meaning that the expense each year was simply the amount of insurance premiums or medical claims paid, depending on the way the company provided healthcare benefits. The FASB revised GAAP to require a completely different approach. According to this approach, the expected future healthcare costs for retirees now must be recognized as an expense over the years necessary for employees to become entitled to those benefits. This is the accrual basis that is also the basis for pension accounting. For instance, shown above is a note to General Motors that describes its post-retirement benefit plan. In this illustration, we learn how to estimate the net costs of benefits in order to determine the post-retirement benefit obligation and the post-retirement benefit expense. The company's actuary should first estimate the post-retirement benefit costs for current employees. As given in this illustration, the estimated net cost of benefits is calculated as the estimated medical costs in each year of retirement minus the retiree share of costs minus Medicare payments. Remember, post-retirement health care benefits are anticipated actual costs of providing the promised health care and not an amount estimated by a defined benefit formulated. This makes the estimate inherently more intricate, especially for the reason being that the health costs in general are very difficult to forecast. Many of the assumptions needed to estimate post-retirement health care benefits are the same as those needed to estimate pension benefits. They are a discount rate, an expected future return on plan assets if the plan is funded, employee turnover, expected retirement age, expected compensation increases if the plan is pay related, expected age of death, and number of ages of beneficiaries and dependents. Also, additional assumptions become necessary as a result of differences between pension plans and other post-retirement benefit plans. Specifically, it's necessary to estimate the current cost of providing health care benefits at each age that participants might receive benefits, demographic characteristics of plan participants that might affect the amount and timing of the benefits, benefit coverage provided by Medicare, other insurance, or other sources that will reduce the cost of employer-provided benefits, the expected health care cost trend rate, After making these assumptions, the company's actuary estimates the net cost of post-retirement benefits for current employees in each year of their expected retirement. The discounted present value of those costs is the expected post-retirement benefit obligation. The post-retirement benefit obligation is the discounted present value of the benefits during retirement. There are two related obligation amounts. One measures the total obligation and the other relates to a specific portion of the total. Note that the accumulated post-retirement benefit obligation, APBO, is analogous to the projected benefit obligation, or PBO, for pensions. Similarly, the APBO is reported in the balance sheet only to the extent that it exceeds plan assets. Now that we know the types of obligation, let us now learn how to measure the obligation. For this, we assume that the actuary estimates the net cost of providing health care benefits to Jessica Farrell, employee referred to in the previous illustrations, during her retirement years, has a present value of $10,842 as the end of 2014. This is the EPBO that we discussed before. Now we will calculate the APBO with the given condition that the benefits and therefore the costs relate to an estimated 35 years of service, and 10 of those years have already been completed by Farrell. Thus it is calculated at 10,842. The EPBO times 10/35, the fraction attributed to service date. Therefore, the APBO is 3,098 at the end of 2014. Here, 3,098 represents the portion of EPBO related to the first 10 years of her 35 years service period. Next, let us calculate the APBO a year later. If the assumed discount rate is 6%, after a year, the EPBO will be $11,493, simply because of a year's interest accruing at the assumed 6% rate. That is 10,482 times 1.06. Note that there is no increase in EPBO for service. This is because the total obligation is not increased by an additional year's service, unlike a pension plan. The APBO, however, is the portion of the EPBO related to the service up to a particular date. Consequently, the APBO will have an increase both because of interest and because the service fraction will be higher, a service cost. Therefore, the increased APBO is calculated as 11,493, the EPBO after a year's interest accrued times 11 divided by 35, the fraction attributed to service to date. Therefore, the APBO at the end of 2015 is 3,612. Here, the 3,612 represents a portion of the EPBO related to the first 11 years of the 35-year service period. We will now see how the interest cost and the service cost attributed to that increase can be separated. We calculate the interest cost as 3,098, the APBO at the end of 2014 times 6%, that's $186. The EPBO after a year's interest accrued amounts to 11,493. Therefore, by multiplying this amount with 1/35, the portion attributed to the year, we determine that the service costs attributed to the year to be 328. Therefore, by this way, we can say that the APBO increases each year due to net interest accrued on the APBO and the portion under the EPBO attributed that year. Attribution is the process of assigning the cost of benefits to the years during which those benefits are assumed to be earned by employees. We accomplish this by by assigning an equal fraction of the EPBO to each year of service from the employer's date of hire to the employer's full eligibility date. This is the date the employee has performed all the service necessary to have earned all the retiree benefits estimated to be received by the employee. Next, let us learn how to determine the attribution period. In our earlier example, we assumed that the attribution period was 35 years and accordingly accrued 1/35th of the EPBO each year. Remember that the amount accrued each year increases both the APBO and the post-retirement benefit expense. Though in illustration, we will learn how to determine this attribution period. Here, Pharaoh becomes fully eligible at age 56, that is, at the end of 2039. As in her case, both the conditions become valid. This means that retiree benefits are attributed to the 35-year period from her date of hire through that date. Graphically, the situation can be described as given in the illustration. On an important note, the attribution period does not include years of service beyond the full eligibility date, even if the employee is expected to work after that date. Now we know it is necessary to attribute a portion of the accumulated post-retirement benefit obligation to each year as the service cost for that year. This is unlike the pension plans where we measured the actual benefits that employees earn during the year. This is due to the fundamental nature of these other post-retirement plans, under which employees are ineligible for benefits until the specific eligibility criteria are met. This is in contrast with pension plans under which employees earn additional benefits until they retire. For better understanding, we look at the graphical representation in the illustration provided. In other words, as given in the illustration, employees earn benefits gradually in the case of pension benefits, whereas under other post-retirement benefits, no benefits are earned by the employees until fully eligible. Concept check. The primary difference between accounting for pension and other post-retirement benefits is the measurement of service cost. Apart from the measurement of service cost, accounting for the two is virtually identical. Suppose a company with an underfunded post-retirement benefit plan with existing prior service cost and net loss, AOCI. We will now see how the company would record the journal entries annually. First, we record post-retirement benefits expense. Each component of the post-retirement benefit expense is recorded in the journal entry to record post-retirement benefit expense. As it is in the expense, we debit the expense with the amount of post-retirement benefit expense calculated. Next, we debit the plan assets as the return on assets increases plan assets. Remember, new gains and losses and prior service costs are reported as OCI, and so in the amortization of their accumulated balances. Also, the service cost and interest cost increase the APBO, and hence APBO is credited with the respective increase amount. Next, we see how the cash funding of the plan assets is recorded. As the cash is contributed towards the plan assets increases and cash decreases. Thus, we debit plan assets account with the amount of contribution and credit the cash account with the same. If we observe, we record the annual expense and funding for other post-retirement benefit plans in the same way we do for pensions. Now we record the gains and losses that occur due to the change in assumption. The loss is an increase in the APBO due to a change in assumption. Thus, in this entry, we record the amount of loss incurred by increasing the APBO balance. Similarly, a gain due to a change in assumption will decrease the APBO balance. Therefore, we debit the APBO and credit gain, OCI. From this illustration, we will now learn to determine post-retirement benefit obligation. For this, we assume the actuary has estimated the net cost of retiree benefits in each year of Jessica Farrow's 20-year expected retirement period to be the amount shown in the calculation part that we look at later. It is also given that she is fully eligible for benefits at the end of 2039 and is expected to retire at the end of 2044. To calculate the APBO and the post-retirement benefit expense at the end of 2016, we begin by calculating the EPBO. We have also been given the steps to calculate the EPBO. The APBO and the annual service cost at the end of 2016, that is the 12 years after being hired. We can see that to calculate the EPBO, first we estimate the cost of retirement benefits in each year of the expected retirement period and deduct anticipated Medicare reimbursements and retiree cost sharing to derive the net cost of the employer in each year of the expected retirement period. The second step is to find the present value of each year's net benefit cost as the retirement date. And the third and final step is to find the present value of the total net benefit cost as of the current date, which is the EPBO. After calculating the EPBO, we next calculate the APBO. Like we did in our previous illustrations, we multiply the EPBO by the fraction attributed to service to date. Finally, to determine the annual service cost, we multiply the EPBO by 1 divided by the total attribution period. As we just discussed the steps to calculate EPBO, APBO, and the service cost in 2016, let us now calculate the same. As mentioned in the previous slide, we assume that actuary estimates the net cost of benefits paid during the retirement years. Next, we calculate the present value of the net benefits as of the retirement date, that is 2044. By substituting in 1, 2, 3 through 20 at 6% discount rate, we find the present value at 2044 for each year after retirement. Thus, as of the retirement date, the lump sum equivalent of the expected yearly cost is $62,269. Next, as per the third step to calculate the EPBO mentioned in the previous slide, we find the present value of the total net benefit cost as the current date, that is 2016. For this, we substitute n equals 28 as there are still 28 years to retire. Thus, we find the present value of $12,182. The EPO by discounting the lump sum equivalent of the expected yearly cost, that is $62,269 at 6% for 28 years. Remember, the APBO is the portion of the EPBO attributed to service to date. Recall that Farrow has completed 12 years of service and the attribution period is given as 35 years. Therefore, the fraction attributed to service to date is 12/35. Thus, by multiplying the EPBO 12 by 182 with the fraction attributed to service cost 12 divided by 35, we determine that the APBO as $4,177. Finally, we calculate the annual service cost at the end of 2016. Remember, the service cost is the portion of the EPBO attributed to a particular year's service. We determined the service cost to be $348 by multiplying the EPBO, 12,182, by the fraction of the 1 divided by total attribution years, that is 1 divided by 35. Accounting for losses and gains in defined benefit plans under International Accounting Standard number 19 is similar to US GAAP, but there are two important differences. The first difference relates to the makeup of gain or loss on plan assets. We know that under US GAAP, losses and gains are the difference between the actual and expected returns. The expected return is different from company to company and is usually different from its interest rate used to determine the interest cost. But under IFRS, we use the same rate, the rate for high-grade corporate bonds, for both the interest cost on the defined benefit obligation called the projected benefit obligation, or PBO, under US GAAP. In other words, under IFRS, we have a remeasurement gain when the actual return on plan assets exceeds the high-grade corporate bond rate we use to determine the net interest cost income. The second difference relates to the regiment of gains and losses after they are initially recorded in OCI. Under US GAAP, gains and losses are to be included among OCI items in the statement of comprehensive income when they first arise, then gradually amortized or recycled out of OCI and into expense. Similarly, to US GAAP under IFRS, these gains and losses are included in OCI when they first arise, but further, unlike US GAAP, these amounts remain in the balance sheet as accumulated other comprehensive income. Now that we know the treatment of gains and losses on plan assets under IFRS, let us learn how they are recorded. Under IFRS, we multiply the rate, say 6%, times the difference between the defined benefit obligation and the plan assets and report the net interest cost or income. We also debit the interest earned from the plan assets. Also, we record the increase in defined benefit obligation balance as the interest is accrued in the balance at 6%. In this slide, we learn how prior service cost is accounted differently under IFRS. Under International Accounting Standard number 19, prior service cost, called past service cost under IFRS, is combined with the current service cost and reported within the income statement rather than as a component of other comprehensive income as it is done under US GAAP. As discussed in the previous slide for global, the service cost would be recorded separately under IFRS in 2015 when the plan amendment occurs. This is in contrast to US GAAP, when it is recorded together as a single PBO amount that includes the current service cost also related to prior service. In this slide, we will learn how pension expense is reported differently under IFRS. Under US GAAP, pension expense is reported as a single net amount, whereas under IFRS, reporting pension expense is divided into the service cost component, including past service cost, the net interest cost or income component of the income statement, and the remeasurement gains and losses as other comprehensive income. As a result, the remeasurement gain or loss under IFRS is usually an amount that is different from the gain or loss on plan assets under GAAP. As we discussed earlier, this is mainly because of the interest rate. IFRS uses a 6% high-grade corporate bond, whereas US GAAP expected rate of return. Notice that under the IFRS, the plan is debited with $12 million. It considers actual interest in excess of 6 and not the expected rate of return. We now see how the OCI items in the statement of comprehensive income are recorded, as we have already discussed in the treatment of the same. Under IFRS, the entries are the same as under US GAAP. However, loss OCI and PBO are referred to as remeasurement loss OCI and DBO respectively under IFRS. Note that loss OCI under GAAP is subsequently amortized to expense and recycled from the other comprehensive income to net income, whereas the remeasurement loss OCI under IFRS is not subsequently amortized to expense, but remains an accumulated other comprehensive income. Accounting for pensions and other post-retirement benefits under IFRS is specified in a recent IASB amendment to its Post-Employment Benefits Standard, IAS number 19. Under the update, the changes that constitute the components of the net pension cost are separated into the cost of service, the cost of financing that cost, and the gains or losses from occasional remeasurement of the cost. The cost of service includes the current service cost and the past cost. It is recognized immediately in the balance sheet and the income statement. Net interest income or a cost is recognized in the balance sheet and income statement immediately as it accrues. Interest is calculated as interest rate times net pension asset, which is an interest income, and as interest rate times pension, net pension liability, which is interest cost. The last component of the pension expense is the remeasurement cost. It includes remeasurements of service costs caused by changes in assumptions, gains and losses arising from experience differing from what was assumed. Investment gains and losses on plan assets. Remeasurement cost is recognized immediately in the balance sheet and the statement of comprehensive income as OCI. Now that we know the components of net pension costs are separated into service cost, net interest cost income, and remeasurement cost, let us now look at an illustration to understand how the components of net pension cost are classified under IFRS. For this, we use the amounts from Global Communications Illustrated. Notice that there is no separate interest cost and there is no expected return on plan assets. Instead, these two are essentially combined into a single measure, net interest cost income. This is because they are combined. That is, the same rate is used for both, 6% in this case, instead of having one rate for interest cost and another for expected return on assets. Now we see how the components of the net pension cost are recorded under IFRS. We report the service cost, net interest cost / income, and remeasurement cost in OCI, as and when each of those amounts occurs. By recording each component, we record the total pension expense. Remember, each component is a change in either plan assets or the defined benefit obligation. So as we record each component, we also record its effect on plan assets and the defined benefit obligation. First, we record the service cost in 2016 of $41. As there is no prior service cost, it is recorded as zero. Recall that we learned how to journalize gains and losses when we were discussing about the difference between accounting treatment between IFRS and US GAAP. When Global adds its annual cash investment to its plan assets, the value of those plan assets increases by $48 million. Thus, we debit plan assets with $48 million and credit cash account with the same amount. We next record the payment of benefits. Recall in the earlier illustration, Global retired employees were paid benefits of $38 million in 2016. The payment of benefits to retired employees reduces the obligation to pay benefits, the DBO. Since the payments are made from the plan assets, the balance is reduced as well. Now we see how to report the components of the total pension cost in the statement of comprehensive income. We report separately the three costs of having a defined benefit plan. In net income, we report the service cost and the net interest cost, while remeasurement cost is reported as OCI. Note that in the journal entries, we have no pension expense being recorded as we had using US GAAP in this chapter. Instead, individual components of the net pension cost are recorded. The reason being that the amendment suggests for components to be reported in the income statement and statement of comprehensive income, not the net total. This concludes Chapter 17.